I would like to introduce Rohit Mathur, the CEO and co-founder of Bridge Marketplace. He'll be speaking about a capital markets update. Rohit is the driving force behind Bridge, a leading platform connecting hotel owners with capital with over 100 commercial lenders. With a background in finance, including leadership at Citi's loan syndications team, Rohit leverages technologies to streamline the loan process for hotel acquisitions, growth, and construction. Rohit.
Good afternoon. I'm going to set my timer because Ahmed was clear. It's 10 minutes. All right. So I thought we'd start at the highest level, right? And maybe we'll do a quick show of hands as you guys are going through your appetizers. How many people have found 2024 to be slightly challenging from a capital raising perspective for new hotels? Just a show of hands. All right. That's a quarter to half of the people here, right, have felt that way. If you think of the macroeconomic situation today, right, I think we're looking at a soft landing 24, 25, despite the fact that you've all probably heard through the year that there's going to be this hard landing of the economy and things of that sort. So in a way, the Fed has kind of cut rates in the right times and kind of managed that in a way that we're not going to experience some sort of hard landing. That's obviously positive for the industry. The inflation target that we're seeing is getting close to the Fed kind of 2%, right? This will be relevant for the next page too when you kind of look at ADR and RevPAR growth, where it is kind of in that 2% range. So kind of experiencing, overall inflation growth versus anything else. And then, GDP is expected to expand. So from a macroeconomic perspective, I know there's a huge election coming up in a month, which could obviously change things slightly, but irrespective of the result, from a macroeconomic perspective, things are kind of stable with rates going down. If you look at kind of the sector that obviously everyone here is most close to, right, which is on hospitality. Within that macroeconomic environment, we're seeing, the TSA kind of people going through the TSA lines continuing to increase, right? So we're seeing that there is a general sort of demand. And across most demand drivers, there continues to be a demand for people going and staying in these hotels. As you can see, even though we're down from 2019, overall, we're continuing to see higher, RevPAR. But like I said on the last page, it is kind of in line in that kind of 2.5% from the inflation. I'll go through some of these slides quicker than others because I know that there's very relevant material for hotel owners in the slides to come. The big question, right? This is kind of what people focus a lot on, which is rates. We've finally seen a rate cut. I think we recently ran a survey, right? And you'll see on the left side of the screen, 50% of lenders on that survey thought that there'd be a 100 basis point rate cut over the next 12 months. Almost everyone expects there to be somewhere between a 50 to 100 basis point rate cut. So that's, as you would imagine, pretty positive news. Right, but I think, again, I don't want to be doom and gloom, right? I think the challenge is that there are two factors at play towards the lending industry right now. There's obviously rates, which hopefully are going down, which is positive. But then the next factor at play is kind of where the banks are, right? And that's more demand and supply issue. I think it's always amazing that there's 4,500 plus banks in the US. Right? Not all of them do hospitality. And I think the chart on the left kind of breaks down by size, right? There's 4 obviously very large banks, and then there's a bunch of regional community banks. If you kind of look at that highlighted portion, it's the banks with assets between 1 to 50 billion. Those banks collectively do 45% of the CRE lending, right? So 45% of that is concentrated almost amongst these 915 banks. And I bet if you ask a bunch of hotel owners in the country, hey, have you gotten a loan from one of these 900 banks? That would be a majority of where you get your loans from. These are community banks. These are regional banks. These are banks who kind of understood CRE. But the challenge that you're kind of experiencing in this space is because these banks, as you look at their kind of tier one ratios and their CRE concentrations, are now being told by their regulators, you got to slow down, right? We see that there's challenges to non-hospitality CRE, obviously in the office space, and those challenges are creating these banks to create a demand and supply issue. So if you take a step back, you're saying, okay, rates are going down. That should be good. I should get a cheaper loan. Yes, but at the same time, you're going to continue to experience, at least for the next 12 to 18 months, a bank lending challenge, which will create kind of a demand and supply issue, where a lot of these banks that were really good at hospitality lending are just going to say things like, hey, my hospitality bucket is full, or my regulator is giving me pressure not to lend, or I'm looking for that perfect project, that perfect project that doesn't exist, right? And so I think that's a good kind of backdrop into what we've seen just in the hospitality space and kind of why you're seeing some of these challenges. We put together this chart, which is a lot of numbers, right? And hopefully you can see the colors on it. But there's two or three takeaways, and I'll kind of get to those soon. I think the two or three takeaways from this chart, and it's broken down by acquisition, refi, and ground up, of course. You'll see a lot of red and yellow on the ground up side. And obviously, I am not telling anyone here anything that they don't already know. But I think what's interesting about that ground up side is there are spots of green, right? So obviously, this chart, the one or two caveats about this chart are there could be any bank that you know that you have a relationship with, that you have a lot of deposits with, that will give you better rates that are on the page, right, or better leverage. Or even though they may be shut down, they may still lend for you, right? So all of that is true, but this is more at kind of a 30,000-foot level. So while you're seeing on ground up construction, a lot of the large banks, regional banks seem more like a yellow or a red. We have seen a huge influx of private debt, right? I think if you open the newspaper any day, any given day, right, you'll read a bunch about how there's a lot of private capital. And I bet everyone's thinking right now, yep, but that private capital is at 12%, 12.5%, which is true. But what we're seeing is that private capital is being able to stretch more on leverage. So if you're doing a ground up project and you were thinking a bank was going to give you 50, 60, I think private capital, we've seen them go up to 70, 75%. They are open to lend, of course, at a higher rate. Right? We haven't seen as much on the acquisition and refi, and I bet as you hear speakers here today, you'll hear of a bunch of people talking about, hey, instead of doing ground up, there's a lot of opportunity to acquire, do a bit, refurbish a bunch of hotels. Three other kind of takeaways, or two other takeaways, right? So we talked about ground up. The other, I think, key point to this chart is that not all LTVs are built equal, right? So I think an LTV of a 75% or 60% from a bank is totally different than what you could get from a private lender. Just one example is developer fees, right? A lot of banks will kind of take that out of the number before they give you that LTV, versus the private lenders that are a little more open to kind of getting that development fee out, even if it is at kind of different intervals. And then, the point that I made earlier, right? While rates continue to get better, so I hope that when we're talking next year, we see all of these charts with 100 basis points less across the board. I think the appetite continues to be limited, which therefore will cause some sort of friction, at least in the short run, for lending. A last kind of point, and this is obviously not macroeconomic, but really more related to what we're seeing with brands. And I think this is an interesting point. I think you saw a lot of brands, right, a lot of flags in the past. Their incentive to make you choose their flag was really key money, right? Hey, we've got a great product. We'll give you some key money as an acquisition source to do that. I think you've now started seeing over the last 12 months, as development pipelines have slowed down, you've started seeing that they're willing to give you, even at times, mezzanine loans. So there's definitely two or three brands that are offering mezzanine products, albeit not well advertised, but they're offering some of those. I think in the next 12 months or 24 months, you'll see that a lot of brands will realize that the key money is great, but if you really want to do ground up, you really have to give an incentive early on, right? Which is something to do with either helping with the equity, helping with the guarantee, helping with key money, kind of coming up with partnerships with certain lenders that are willing to do certain products. And I think that's a trend you'll probably start seeing more and more of as we go forward. So I'm going to do a quick time check so I'm not over. here are some conclusions, right? And again, we'll probably share these materials so you guys can go through these. As I've said, I think community and regional banks will continue to experience challenges, at least in the next 12 to 18 months. Some of that stuff will get cleaned up and then, they'll come back. Despite kind of lowering interest rates, the kind of bank appetite will be impacted by that. So that's something to kind of keep in mind. There are opportunities for certain banks. So if you think back to that chart, there's 915 banks that definitely aren't on the right side of the tier one ratio. That said, there's 4,500 banks in the US, and many of those banks who don't have as much commercial real estate exposure or hospitality exposure will now see an opportunity to jump in, right? And conceivably come in with deals that underwrite better at higher rates, and as the rates go down, get better for them, right? With reduction of rates, we'll continue to see this private debt market be a huge part of the story over the next 12 to 18 months and longer. And so I think that's it's an important factor. A lot of people look at the headline rate on private debt, but I think there's things to consider like C-based financing and things of that sort, which can help you bring that yield down. Obviously, retroactive C-based, but also kind of new construction C-based can help you do that, right? Like we said, we think capital solutions will be a key part of what brands are thinking through. I think the jury is still out on how many of them do what, but I think they'll start thinking about solutioning for capital. 2025 will be a key year for corrections, right? You'll see a lot of the 2019, 2020 vintage stuff that was put out there needing to get refi, especially if it was kind of 3-4 year, 5-year bridge loans. After the extensions, they'll continue to get refied, and you'll see some corrections, right? Which means there's opportunity for people in this room to take advantage of those corrections. And as certain assets are trading at the right probably valuation, I know Emma mentioned the kind of valuations being reset. As assets are being traded at the right valuation, finding those deals, and you'll find the capital to kind of support that, especially for acquisitions and refis. I think acquisitions will continue to see a robust market in 2025, so will refi. I think roundup will kind of take a little longer to come back, but there's opportunity out there, and I'll kind of end on a positive message, right? Which is that despite there being kind of record high interest rates, we've kind of passed that, right? We've gone past the hump of the highest interest rates. We've probably gone past the hump of some of the largest dislocation in banks. I mean, with the large banks experiencing challenges last year. And so really, you should see a bunch of those headwinds start to turn into tailwinds over the next 12 to 24 months. That's all I got. Thank you.